what really makes the difference of an investor's outcome over a long duration period of time? It's probably not what you think. My name is Wes Rowlands. For those of you who don't know me, I'm a partner at Attic and Wealth Partners, founding partner. We manage about $600 million as of a couple of days ago, and I've been doing finance now for about 20 years. And I want to teach you the actual wealth building stuff that I see every day with actual real life humans, not theoretical academic versions, watered down concepts. So oftentimes people think that getting excessive returns is the answer, when the reality is boots on the ground data from my experience shows me it's actually a lot about investor behavior. And I'll prove the point. If we think about this, let's say we have 4 different types of investors, and I've seen all of these archetypes with investors basically on a weekly basis for the last 20 years. Let's say investor number 1, which represents a lot of investors. In fact, I would say this is the typical investor. Well, I guess number 1, most people are just not investors, but people who actually do invest, they're like investor number 1. Investor number 1 in this example has a plan of investing $10,000 a year, let's say for 30 years, and he's planning for retirement in 3 decades. What actually happens though is maybe on the first year he invests $10,000, but then the next year he invests less than that. So to simulate this, I said, okay, well, what if investor number 1 invests $10,000 a year, and then every other year he undershoots the mark and he invests $6,000 instead? Again, this is very common from my experience. So what happens oftentimes, this investor is not automating the process. He's leaving it to the end of the year and he's making a decision, oh, do I want to invest money this year or do I not want to? And again, you can change this for monthly or weekly or annually, but the concept still remains the same. It's manual intervention as opposed to automation, which almost always leads to very inconsistent inputs, which then leads to inconsistent outputs. So in this particular case, this guy, if you were to invest $10,000 per year, except every other year he misses the mark and he underinvests, so every other year he invests $6,000. He would end up with, over 3 decades, he'd put in $240,000, which is great. And which is even better, he would end up with about $1.3 million. We're gonna use this as the base case. Now, if we go to investor number 2, I would define this as the second level of investor. This investor actually invests $10,000 per year, and the key is he automates it. So now he is actually able to consistently input the right investment. Well, what would he end up with? Again, same plan, same exact investments. It's 10% per year over 3 decades. The only thing that's different is he automated it. So every year he actually invested $10,000. Now, I don't want you to sleep on that term. There's a mountain of difference between what humans plan on doing and then actually do. And the reason I love finance so much is because we actually get to see not just what people think or plan to do, we actually get to see a historical representation of what they've actually done. So in this particular case, let's say this hypothetical investor number 2 has actually invested $10,000 per year. Okay, big difference. This guy ends up with $1.6 million, as you can see here, $1.6 million, as opposed to $1.3 million. We have an increase of $313,000 just from actually sticking to the plan, which is about a 23.5% increase. Again, not a 23.5% increase from investment returns of getting better vehicles, of just inputting more dollars into the system. Now, I know this sounds so obvious when I say it out loud, but I promise you, it's not common practice. What is way more common practice is, number 1, most people don't invest at all. Number 2, what is also common is people sporadically invest, which this would be like investor number 1 in this particular case. Less common is investor number 2, somebody who actually sticks to the plan and they invest $10,000 per year, insert whatever number you want, but $10,000 per year in this case. And at the end of the 30 years, this particular person has $1.6 million versus 1.3 in the first case. Now, big aha here, which again sounds so elementary, but I promise you it's super impactful. Instead of investing a flat dollar amount every year, invest a percentage of what you make. And you've probably heard this a million times, but maybe you don't understand the concept, but are less familiar with the actual magnitude, the size of the impact. So now let's just say you're working and you start to get raises each year. And let's just say that raise is 5% per year. Let's just say that's the number. So you invest proportionally the same. So now instead of investing a flat dollar amount, you choose to invest a percentage. This is a very, very big difference. So in this case, investor number 3, just by choosing to invest a percentage of her income as opposed to a flat dollar amount. In other words, every time she gets a raise each year, she would invest more money because it's a percentage base. The difference here is pretty outstanding relative to the base case. So if we look at investor number 3, right, increasing her dollar amount every year based off of her raise, she would end up with $2.6 million. That is a $1.3 million increase almost from the base case of $1.3 million. This is enormous. Again, we haven't changed anything with the underlying investments, so you don't have to find any unicorn investment that's going to get you some bigger, profound return than the air quotes norm. All we're changing here is the inputs, specifically a percentage-based input versus a flat dollar-based input. Now, the fact that you're even watching this right now probably means that you want to be a financial leader for your family or for your business, etc. You're probably motivated to make more money as you scale in your skill. So there's a very good chance that your income is not just going to increase linearly. You're going to increase exponentially. So as an example, one of the best investments you can make is in the investment in yourself and your skills. So if you do that, you will likely have an increase in income each year, but it's more going to be, right, smaller percentage-based increase, let's say for a couple years, and then every like 4th year, you're going to jump in a big stair-step way, because essentially you would reach critical mass of a certain skill. Let's say you're a videographer and it takes you a little while to really gain the skills of being a top-tier videographer. So you get compensated, and then every once in a while you hit a new plateau in a good way, and it's like, oh man, all of a sudden my skills surpass this membrane that now puts me into the high-end professional category. So my income now jumps by 30%, let's just say. So you get these big jumps on occasion when you're really after skill acquisition. So in this case, to simulate this to a moderate degree, we're going to say this is investor number 4. Investor number 4 still does the same thing as investor number 3. Increases her investment because it's percentage based, but now she's increasing her income disproportionately every few years. So to simulate this, we said it's the same as investor number 3, but 10% increase every 4th year, which in my opinion is actually a pretty conservative estimate for somebody who's a killer and who wants to increase their income and focuses on it over a long period of time. Well, this difference is enormous. Look at this, $2.9 million, $2.95 million versus the base case of 1.3 million. Again, this is the power of focusing not just on the investments, because that's what so many people want to talk to me about. They want to come into the office and say, hey, how can we increase my returns? And I say, wait, time out. Let's remember, the way you build wealth over time, wealth building is not investing. Investing is a component of wealth building. The actual formula for wealth building is, per my opinion, is number 1, make money. Number 2, save money. Number 3, grow the money. Number 4, protect the money. What most people could benefit from is actually if we focus first and foremost on making more money. And we have to build skill sets to do that. But if it's like a funnel, if we focus more on making more money, then as a function, we have the potential capacity to save more money. If we have the potential capacity to save more money, then we could invest more money to grow it into the future. It's really important to not just understand the concept, it's to understand the magnitude. Just by those few tweaks, not changing the investments, we have transformed a $1.3 million investor in the same period of time to a $2.95 million investor. This is a 122% increase almost. That's crazy. You're not gonna find many investments on the planet that will get you anywhere close to that level of return. And the cool thing is, it's basically entirely in your control in terms of earning more money. You are way more in control of that than in control of the stock market or other investments outside of yourself. So I hope this was helpful. If you like this kind of stuff, please like and subscribe or send us any questions. We'd be happy to help however we can.